Okay, welcome everyone to What Would Peter Lynch Do? This is our deep dive into the thinking of the legendary Peter Lynch. It's Thursday, May 22nd, 2025 today. And, the main indices are a bit, mixed. But Microsoft, it's interesting. It seems to be pushing towards its all-time high again.
Yeah, it really is interesting. Markets go up, they go down. It's constant, right? And Microsoft's move, definitely something to watch. But like Peter Lynch always warned, trying to predict exactly what a stock will do next, that's usually not the best strategy.
Exactly. Which actually leads perfectly into a question we got from one of you listening. Someone asked, what exactly are all-time highs and 52-week highs? So today we want to, unpack those terms. What do they mean? And importantly, can a stock keep climbing after hitting those points?
That's a really common question and a good one. These terms, all-time highs, 52-week high, they're basically markers of past performance. And looking back can give you some context, sure, but it's really crucial to remember they don't guarantee anything about the future. Peter Lynch, he always hammered on the point, understand the business, don't try to time the market based on price moves alone.
Okay, let's break it down then. An all-time high. That's just the absolute highest price a stock has ever reached since it started trading.
That's it, the peak price, historically speaking.
And the 52-week high is similar, but just looking back over the past year.
Precisely. Highest closing price in the last 52 weeks. They sound impressive, like you said, sort of like badges of honor.
But they are backward-looking, right? Just telling us what happened before.
Exactly. That's the key takeaway. Now, don't get me wrong. Hitting a new high can be a positive sign. It might suggest momentum, strong investor confidence. Maybe it points to good things happening with the company itself, like earnings growth or solid fundamentals.
Right, but it's not a guarantee. We hear that all the time. Past performance doesn't predict future results. So, okay. What needs to be going on under the hood, so to speak, for a stock to actually keep rising after hitting one of these highs? What makes it keep going up?
Well, if we think about it through Peter Lynch's lens, a few things really stand out. First, and probably most important, earnings and growth. Are the company's profits still climbing? Is the outlook for future growth strong? Lynch wrote about this a lot. Ultimately, stock prices tend to follow earnings. So even if a stock's at a high, and maybe its PE ratio, the price to earnings is expensive.
Yeah, that number that tells you how much you're paying for each dollar of earnings.
Right. Even if that PE looks high, if the company's growing profits really fast, that high PE might actually be perfectly fine. It can still be a good buy.
Okay, so growth is key. It can justify a higher price tag, essentially.
It absolutely can. Then there's what Peter Lynch called the story. He famously said you should be able to explain why you want a stock in like 2 minutes. That story isn't just the past. It's what's happening now and what's coming next. New products, new markets, strong competitive advantages, what Warren Buffett calls a moat.
The moat, keeping the competition away.
Exactly. If that story, that forward-looking picture is still exciting and credible, even after hitting a high, well, maybe the stock has more room to run.
It's like you need to believe the next chapter is going to be good too, not just the one that got you to the high point.
That's a perfect way to put it. Now, sure, things like overall market conditions or what's happening in the industry can matter, but Lynch wasn't big on making decisions based on broad market predictions. Focus on the company, he'd say. And finally, valuation. Even at a new peak, is the stock actually expensive relative to its growth? Lynch pointed out, a stock could double one year and still be a bargain the next if its earnings grew even faster. It's all relative.
Okay, that makes sense. What about insiders, like executives buying their own company stock? Lynch talked about that.
He did, yes. Insider buying can be a positive signal. But who knows the company better, right? If they're putting their own money in, it suggests they're optimistic. But Lynch cautioned against using it as your only reason to buy. It's just one piece of the puzzle.
So really, even with these highs, it comes back to Peter Lynch's classic advice. Invest in what you know. Do the homework on the actual business.
Absolutely. Forget just staring at the price chart. Dig into the fundamentals. What are the earnings doing? What's the growth potential? How strong is its position against competitors? That company-first approach, that's pure Peter Lynch.
Right. And we are exploring Peter Lynch's wisdom here on what would Peter Lynch do. Now, I mentioned earlier we might bring in some other perspectives, other investment giants. How might someone like, say, Warren Buffett look at a stock hitting new highs?
Oh, that's a great angle. Bringing in Buffett definitely adds another layer. Well, his famous saying, price is what you pay, value is what you get. So for Buffett, even if the price is high, maybe at an all-time high, if the underlying value of the business is still higher and growing, then it might still be attractive.
So the price tag itself isn't the whole story. It's about what the business is actually worth.
Exactly. And Buffett also had that quote, something like, the stock market is just there to see if anyone's doing anything foolish. His point was, don't get swept up by market sentiment or short-term price moves. Focus on the long-term value of the business itself.
Makes sense. Focus on the business value, not just the market noise. And Buffett, he really emphasizes that moat concept too, doesn't he? That competitive advantage.
Oh, absolutely. The economic moat is huge for Buffett.
When?
A company that can defend its profits, keep competitors at bay, that's a company built for the long haul. And those kinds of companies, well, they can often justify higher valuations, even ones near all-time highs, because their future looks more secure. That's definitely something to look for.
It really feels like, whether it's Lynch or Buffett, the core idea is, well, it's about deep understanding and thinking long-term, isn't it?
It really is. Understand what you own, why you own it, and focus on the long game.
And, thinking about it, that principle, it doesn't just apply to stocks, does it? It seems like pretty solid advice for, well, life in general, making big decisions.
I couldn't agree more. Taking the time to really understand a situation, looking beyond the immediate surface level, and having that long-term perspective, it usually leads to better choices, whether you're managing money or navigating personal challenges, focusing on real value over fleeting appearances. Yeah, wise counsel anywhere.
So, summing up our deep dive today, those all-time highs, those 52-week highs, they tell you where a stock has been. But deciding if it can keep going, that means looking deeper, like Peter Lynch taught us. Understand the earnings, the growth, the story, the moat, the valuation. Know why you'd invest. Okay, so here's something for you to think about before next time. Pick a company you know, maybe one you follow, or even use its products that's recently hit a new high. Try applying some of these ideas we talked about. Does its story still look good? How's the growth? Does it seem like it could keep going? Do a little digging yourself. That's all the time we have for this deep dive into what would Peter Lynch do. Thanks so much for joining us. We'll catch you next time. Have a fantastic day.